Hello everyone, I'm Chloe. Today I'll be reading Glassnode newsletter week 51. According to market data, 90% of all bitcoins set to ever enter supply have now been mined. Reaching the milestone took nearly 12 years since the first bitcoins were mined on January 9, 2009. However, the remaining supply is not expected to be mined over the next 120 years or so. We cannot predict the future, but we are watching history in the making. Great tools like Glassnode on-chain analysis can help us to achieve our goals. In this week's newsletter, we will explore how Bitcoin investors are currently positioning themselves in the following areas: an observable slowdown for both loss realization and profit taking, an assessment for which supply cohorts are transacting on-chain right now, a continuing trend for steadfast accumulation behavior by stronger hands. Bitcoin endured a second consecutive week of price ranging, following the sharp drawdown in early December. Many eyes were on the Federal Reserve's comments following the Federal Open Market Committee meeting on Wednesday, and broader markets generally traded in consolidation throughout the week. Spent coins get younger. A common behavior when prices make new highs is for profitable coins to be spent into market strength. Holders from lower prices want to pay themselves for the effort of waiting and taking on risk, and it results in profit taking and elevated activity from older coin cohorts. The spend volume age bands filtered below to display spend coins older than 6 months illustrates what older spending volume can look like. In the late 2020 bull run, coins older than 6 months spending compressed 7% of on-chain volume. Since then, successful peaks of spending from this group have declined, topping at just 3.5% of daily volume at the recent highs. This dynamic is also visible in the realized cap holder waves, which divvy up the circulating supply by their respective weighting in the realized cap, helping to emphasize recent spending. A key observation in the realized cap holder waves is the compression of the 3 to 6 month wave, which are owners of coins bought between mid-June and September, essentially the year's lows. A squeezing of the 3 to 6 month band, while the senior 6 month to a year band bells outward shows coin maturation. As BTC lies dormant and accrues age, it graduates into the older cohorts above. In lockstep with the growing of the older 6 month to a year group, it's a rise in the youngest bands in October and November at the market all-time high. This behavior shows older coins being spent, which reset their lifespan to 0. Based on the squeeze of the 3 months to 6 month band and the 1 to 3 month band to a lesser degree, much of the recent spending emanated from these mid-term holders. The take-home message here is that much of the coin spending underway appears to be the coins purchased in the last 3 months to 6 months, rather than longer-term holders. Among the investors anticipated to take action at the recent highs were long-term holders, who are consistent distributors in price discovery. The cyclic nature of long-term holders is as follows: steady accumulation in bearish market phases, eventually reaching a level of peak hodl. Spending of profitable coins at the all-time high, realizing profits into market strength. By the time price peaks and rolls over, long-term holders have begun net accumulating again. Distribution events, visualized below as the 7-day change in long-term holder supply, typically result in peaks of 2% or more supply moved to new buyers. However, the recent all-time highs and subsequent pullback have seen a peak spending rate of only 0.6%, just 30% of the expected amount from long-term holders. These low-time preference investors seem reticent to spend at current prices, which may speak to a sophistication in their decision-making. Short-term coins play musical chairs. New investors are the first group tested by price weakness. In the days following the November all-time high and beyond the liquidation flush of December 4th, loss realization on chain of $50 to $100 million per day was common. For loss realization to occur after an all-time high, those spenders must be top buyers. Net realized profit/loss visualize the daily outcome of on-chain spending in USD terms. Observe consistent profit-taking around the all-time highs as coins from lower prices are spent to new buyers. Steep loss realization in the days afterward as price pulled back over 30%. Losses realized after all-time highs indicates coins purchased at the top. Relatively flat activity in the past 2 weeks, suggesting investor interest is reaching an exhaustion point at recent price. With the understanding that older coin spending is declining, and longer-term holders mostly on the sidelines, we can intuit that recent coin activity is largely contained within the short-term holders. A look at the standing profit-loss ratio of short-term holders can show the health of this group's supply and illustrate periods of overheated price action. High values over 1,000 in red indicate moments of extreme profitability for new investors. These moments are believed and often precede local reversals. Values between 100 and 1,000 in yellow means newer buyers are in healthy profits. Values below 1 in blue indicate short-term holders in loss. Low values near or below 0.1 in green are moments of heightened vulnerability of new buyers, and frequently mark local bottoms where value is established. Short-term holder P&L spiked dramatically in late October as price rallied to all-time highs. Buyers of coin from August and December suddenly found themselves up 60%, and the market had to pull back to accommodate profit-taking. Presently, short-term holders find themselves in aggregate loss, though the pace of decline has slowed along with price. While these coins continue to churn among different hands, their lifespans stay young and they remain members of short-term holder supply. The rotation of coins among newer owners can also be seen in the rate of change of short-term holder realized price. As owners of the younger supply, their cost basis is more responsive to price than their long-term holder cousins. Interpretation of cost basis for each cohort is nuanced and different. Short-term holder realized price rises when coins are spent from lower prices, causing them to be repriced higher and thus raising the aggregate cost basis of the group. Short-term holder realized price declines when price falls, coins from higher prices are repriced into new hands at lower cost, pulling down their cost basis. Long-term holder realized price rises when coins mature from increasingly higher prices as Bitcoin appreciates. The delay in adoption of this group makes their cost basis less responsive to price and more beholden to maturation behavior by hodlers. Long-term holder realized price declines rarely and typically only in prolonged bear markets. Rather than fall, it tends to go sideways as coins mature during long-ranging periods for price. Note the recent increase in short-term holder realized price at the October and November highs, showing the repricing of coins at higher prices as new investors bought the literal top. The ultimate perspective of coin rotation within the short-term holder group is seen in the percent of entities in profit. A remarkable observation on this chart is the arcing trend from late July to present day. In late July, price was $32,000 and 76 of all entities on chain were in profit. When new highs were created in October and November, 100% of entities were in profit, an expected outcome for price discovery. Now in late December, price is $47,000, over $15,000 higher, and there are again only 76% of entities in profit. For price to be over $15,000 higher than summer, while the same amount of investors are in profit, knowing that older spending is muted, a great shuffling of coins had to take place at the top within the short-term holder group. That means there were coins mostly purchased since July, and signals that the current holder makeup is top-heavy. Many coins were bought at the top and now sit underwater. As a cherry on top of the discussion about top-heavy supply, we look at the unrealized price distribution, which shows all circulating BTC by its last transacted price. A quick glance reveals that 24.6% of all supply is sitting above the current price, around $47,000, meaning 1 in 4 BTC is currently underwater. Despite weakness, strong hands continue stacking, a behavior that has left its stamp on the 2021 Bitcoin market is the steadfast accumulation by investors with a limited history of spending. Illiquid supply is the amount of BTC held by on-chain entities with larger or equal than 75% inflows in their ledger history. The supply in possession of these illiquid entities sold off in May along with much of the market. Since that time, they have maintained a consistent pressure of accumulation and are now taking possession of coins at a rate of 3.4 times daily coin issuance. Put another way, strong-handed hodlers are observing supply at more than triple at the rate of new coins being minted each day. Strong hands are not the only investors pulling coins away from potential buyers. After a large impulse of deposits to exchanges in May, over $300 million on a 14-day basis, Bitcoin has been steadily put offline into cold storage in the month following the summer lows. The chart below shows the net transfer volume to or from all exchanges, which is the difference between all deposits and all withdrawals in USD terms. The initial all-time high breaks in late October saw around $100 million of inflows, but the weeks following have been dominated by consistent exchange outflow volume, seeing average value of $150 million to $175 million on a 14-day basis. Price weakness has so far not engendered a rush to the exits, as investors are instead creating friction between their ownership and their ability to sell their BTC. One group that doesn't have a reputation for being strong-handed is the miners, who have been a consistent source of spending pressure on the Bitcoin network since inception. Well, perhaps their reputation is in need of an overhaul. In the past 2 years, miner behavior has undergone a transformation. Newer, more powerful chips have enhanced operational efficiency, and the expansion of miners into North America has given many of them access to operating capital by accessing cheap debt and corporate equity. The typical miner in 2021 is more resilient than the past generations. What once was a reliable outflow of spending from miner wallets has shifted since 2019, and miners are now depositing more minted supply into their treasuries than before. The chart below shows a 90-day sum of miner net flow volume in US dollars as a percentage of market cap, and the multi-year rise is evident. If miners evolve into being hodlers, a group who are naturally incentivized to spend, then acquiring new Bitcoin into the future could become exceedingly difficult. In case you missed it, the past week saw circulating supply pass the 90% mark of its ultimate goal, with circulating supply passing 18.9 million BTC. In just under 13 years, 19% of total BTC supply has now been issued to miners. In just under 13 years, 90% of total BTC supply has now been issued to miners. Bitcoin's deterministic issuance schedule has much farther to go, however, with the remaining 10% of supply set to be minted over the next 120 years or so, ending somewhere near the year 2140. With so many holder types stacking BTC for long-term, future opportunities to acquire the world's first absolutely scarce digital assets are now increasingly limited. Thank you so much for watching, and I'll be sharing more in the future.